Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So in my second example, I'm targeting 73 as my optimal point, and that's illustrated as the purple line down below. My profit zone is that entire yellow band, and you can see based on where I'm at right now that I'm actually outside of the yellow band. Whereas my orange trade might have been slightly bearish or slightly bullish to neutral, it's clear that in order to get down into that yellow zone, I'm going to have a pretty good drop in the value of this index. So I am clearly much more bearish in this particular strategy. I want this thing to drop from 75.58 to as close to 73 as I can actually get. Now, if I'm wrong and it stays right where it's at right now, I'm above my highest strike of 75. How much am I going to lose? $200. That's my upper max loss. It's very unlikely, I would say, on this particular trade that I'm going to hit the max loss to the bottom. My max loss to the bottom is going to be all the way to zero. Well, I shouldn't say my max loss, but it's very unlikely that I'm going to hit my loss zone. If my upper and lower break-even range is 71.20 to 74.80, this index has to drop all the way down below 71.20, which is the very bottom of that yellow zone, in order for me to lose money. Well, you can see again by looking at roughly 5 months worth of chart here that this thing has not been below that level. Now, going back into April and mid-March, you can see that it was right at my max target, or my target there of 73. In fact, you might even be able to argue, if you're a technical guy, that that 73 level is a support line, because you can see that it came down there in mid-April and bounced right off that line and headed higher. So that could very well be a support line, which would be ideal, right? If it came down and hit that thing and then supported and held right there, that's exactly where you want it to be. But you can see I got to have a pretty good downside move in order for me to hit my max target. But anywhere in that yellow zone is okay. I can make a profit there. Again, what's neat about these put ratio spreads is that they don't cost a lot to put on, and you can set your zone wherever you want based on the strikes you use, but they don't necessarily get more expensive or cheaper based on your target zone. It's just about you picking what target you're looking for and then setting it up for this trade. All right, let's take a look at one more strategy. Let's talk about put ratio back spreads. Now, this is a kind of a creative trade, and if you look at it, you'll notice that it looks kind of like the inverse of the one we were just talking about. Well, that kind of is what it is. Now, you might go, well, wait a minute now. If I'm bearish, why would I want a trade that takes me down into a loss zone if it goes lower than where it's at right now? Well, it depends, again, on how bearish you are. If you're extremely bearish, you might be able to blow all the way through that loss zone and then hit the big profit zone that occurs after that. So we're taking a look at a couple of examples here. An in-the-money put ratio back spread, the orange trade would be a moderately bearish trade. In this example, I would buy 20 of the BPX, which is the British pound, against the dollar versus the British pound. I'm looking at September $63 puts at $1, and I could sell half as many of the September 65 puts. So remember in the previous example where we were doing a put ratio spread, I was going to sell twice as many as I buy. In a put ratio back spread scenario, I'm buying twice as many as I sell. So I'm still ratioed here where I've got a 10 by 10 spread and I got 10 left over. But in this example, instead of the 10 leftovers being naked where I'd have a higher margin requirement, my 10 leftovers are just long options. So I don't have any margin, but I do have to pay for them. So I can calculate my break-evens, max losses, and max gains, and all that. This trade is actually done at a net credit, so I get paid up front on this trade. So that's kind of neat to get paid up front. Now remember, when you get paid up front, your goal is typically to hold on to as much of that as possible. But in the case of a ratio spread, you might even be able to do better than that. So I calculate my lower break-even price by looking at the long strike, which is the 63, and subtracting the amount of the maximum loss. And we know what the maximum loss is based on the net of the strikes minus the amount of the credit. So this is a 2-point spread. I subtract the amount of the credit I brought in, which is 45, and I end up with a maximum loss of $1.55. Then to calculate my lower break even, I take my long strike and subtract my max loss, and I end up with a lower break even down around 61.45. Now, unlike the put ratio spread, I don't want to be between my break evens. I want to be outside of my break evens on this one. Okay, so my lower break even is 61.45. That means I want to be below 61.45. My upper break even is calculated as my short strike price minus the amount of the credit I brought in. So that's the 65 minus the 45. That puts me at 64.55. And you can see based on the generic P&L chart there that I can actually gain a really small credit or a small profit if I'm completely wrong on this trade and it actually goes against me. And the amount of that small credit that I can earn is that credit that I brought in when I put the trade on, or that 45 cents, which in this case would turn out to be $450. My maximum loss we calculated again as the net of the strikes minus the credit. And then our lower max gain, which is the goal we're actually trying to hit, is to make as much as possible to the downside. Well, that's not reality because we know that this is an index and we know that the dollar's not going to go to zero versus the pound. If that happens, we got a lot bigger problems than this. But our goal is to get down into that green zone on the downside as much as possible, and the further the better. So if you're really bearish on the dollar versus the pound and you think it's just going to continue to slide and slide and slide, and we've seen a pretty good slide lately, this is the kind of trade that you can put on, get paid up front, and capitalize really nicely if it just falls out of bed and goes a lot lower. Our upper max gain, as I said, occurs when it goes beyond 65, which is the short strike price, and the amount that you would get at that point is just the credit that came in. Because what happens when this thing closes above the highest strike price? Well, both of these options expire completely worthless, right? A $63 put and a $65 put don't have any value if the stock or if the index is above 65. So that little small credit that you brought in up front, you get to keep if you're completely wrong. I kind of like to think of that as the consolation prize. Okay, you completely blew it. Things went exactly the opposite of what you thought, but you got to keep a small consolation prize and you move on and do something else. Now, the at-the-money spread, in this case, would be a much more bearish trade. And similar to the other example, this trade doesn't necessarily get more expensive. In this case, it's a nickel. It's about a nickel difference in price, but it allows me to target a different range. Remember, I want to be below my lower break-even or above my upper break-even. So first of all, let's calculate our maximum loss. We know that this is a 2-point strike spread between the strikes. We got 50 cents when we came in when we put the trade on. So our maximum loss is the net of my strikes of 2 minus 50 or $1.50. And the maximum loss occurs when I'm in that red zone, when I'm in between those two break-evens. So we'll calculate the break-evens. The long strike minus the max loss, which is 61 minus $1.50. That puts our lower break-even at 59.50. And the short strike minus the amount of the credit, which is 63 minus 50. That puts our upper break-even at 62.50. So I've got a zone there between 59.50 and 62.50 where I don't want to be. My lower max gain, of course, occurs at 0, which isn't realistic, but ideally we want to be as low as we can. And our upper max gain, which is our consolation prize, occurs if we're completely wrong and this index rallies and both of the options expire completely worthless. We get to keep that 50 cents that we brought in up front. And you can see how that would occur. That would occur above 63. So I'm targeting a different zone here. Now let's look at that on the chart, and you'll be able to see the two different zones that we're looking at. I know there's a lot of lines and colors on here, but I put them on here so I could illustrate this trade a little bit. So the first one, we've got a lower break-even of 61.45 as we calculated. The 61.45 lower break-even is illustrated on the bottom by the top of that orange zone, okay? And the upper break-even is 64.55, which is illustrated by the orange line.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.